Many beginners use RSI, but here's the real problem. Most of the time, they are late. When RSI gives the signal, the move already started. You enter and price is already tired. So today I'm going to show you a faster version of RSI. It's already inside TradingView and you don't need to download anything. It's called Stochastic RSI. But here's the important part. Many traders say a stochastic RSI gives too many fake signals, and they are right. So in this video, I will show you what a stochastic RSI really is, how it's different from normal RSI, how to use it correctly, and at the end, I will show you how to make it much more reliable using only two simple rules. So let's get started. What is a stochastic RSI? Look at your chart. First, add the RSI indicator. You already know this one. It moves between 0 and 100. It shows us momentum. It helps us understand if the market is strong or weak. Now go to the indicator section, search for stochastic RSI and add it to your chart. You will notice something immediately. It looks similar to RSI, but it moves much faster. And this time, you will see two lines instead of one. So, what exactly is it? Let me explain it in a very simple way. As you can see, RSI is a line moving up and down. Now imagine we take a magnifying glass and zoom in on RSI itself. That magnifying glass is stochastic RSI. It does not look at price directly. It looks at RSI. So, stochastic RSI measures how RSI is moving and where RSI is compared to its recent range. In simple words, RSI tells us about price movement. Stochastic RSI tells us about RSI, or even more simply, stochastic RSI is the RSI of RSI. That's why it moves faster, and that's why it reaches the top and bottom more often. And that's also why many beginners get confused when they first see it. But don't worry, in the next part, I make it very easy to understand. Difference between RSI and stochastic RSI. Now look carefully at your screen. First, watch the RSI line. See how it moves? It goes up, goes down, but in a calm, smooth way. It does not react too fast. It takes its time. Now look at the stochastic RSI. It moves much faster. It jumps from the bottom to the top very quickly and then back down again. Its range from top to bottom is much wider than RSI's. That's the main difference. The RSI is slower and more stable. It measures the strength of momentum, whether the market is gaining strength or losing it. But the stochastic RSI is faster and more sensitive. It reacts to smaller changes inside RSI, so it gives us timing signals, small moments when momentum starts to shift. Think of it like this. RSI is like watching the big waves of the ocean. They move slowly and show how strong the tide is. But the stochastic RSI is like watching the small ripples on top of those waves. These ripples move much faster, changing direction quickly, sometimes even before the bigger wave changes strength. That's why stochastic RSI can give you warning earlier than RSI. When momentum starts to increase, stochastic RSI often reaches the overbought zone before RSI does. So it's faster, but it also gives more false signals. Because it reacts to every small move, it produces many more signals, and not all of them are useful. If you follow every crossover and every spike, you'll take too many trades, and that's called overtrading. Most beginners lose money exactly because of this mistake. So, we need a structure. We need clear rules to separate useful signals from noise. And that's what we are going to learn in the next part. How the two lines in a stochastic RSI work and how to use them together the right way. How to read a stochastic RSI. Now focus on the stochastic RSI panel. You see two lines. Usually one is blue and one is orange. The blue line is called K. The orange line is called D. The K line is the fast line. It reacts quickly to momentum changes. The D line is slower and smoother. It follows the K line and helps confirm the signal. Think of them like two moving lines racing each other. We also have two important zones. Above 80, this is overbought. Below 20, this is oversold. Now watch what happens when price drops. When price drops strongly, stochastic RSI goes below 20. This means RSI itself is becoming very weak. Now watch the moment when the blue line crosses above the orange line while we are below 20. That's a possible early bullish signal. Not because price already moved, but because momentum is starting to change. The same idea works on the top. When a stochastic RSI is above 80 and the blue line crosses below the orange line, that's a possible bearish signal. But please listen carefully. If you take every crossover, you will lose. So we must filter the signals. And in the next part, I show you a very simple way to do that, using only two lines and two rules. Make it reliable with only two rules. Now we know how to read the stochastic RSI. We know the K line, the D line, and the zones. But here's the problem. If you take every single crossover, you will lose money. So now let's make it more reliable using only two very simple rules. You don't need anything advanced. Just follow these two filters. Rule number 1. Only trust crossovers at the extremes. That means for a buy signal, we want the K line to cross above the D line below 20 in the oversold zone. For a sell signal, we want the K line to cross below the D line above 80 in the overbought zone. If the crossover happens in the middle between 20 and 80, we simply ignore it. We don't care because the middle is where most of the noise lives and we don't want to trade noise. So the first rule is very simple. If the crossover is not in the extreme zones, we just ignore it. Rule number 2. Wait for a small confirmation from price. Stochastic RSI is all about momentum, but price action still matters. So instead of entering immediately on the crossovers, we add just one small extra condition. For a buy setup, first we see the K line cross above the D line below 20. Then we wait for one small sign from price, for example, a candle that closes higher or a small bounce in price. For a sell setup, first the K line crosses below the D line above 80, then we wait for a candle that closes lower or a small rejection from the recent high. In simple words, the stochastic RSI tells us momentum is changing, and then price tells us, yes, I agree. When both says yes, that's a signal we can actually trust. Now remember, we're not trying to catch every signal move, and we're not trying to be perfect. We're simply avoiding the worst and most obvious false signals. Two simple rules. 1. Only crosses in the extreme zones. 2. Always wait for a quick confirmation from price. And that's it. That's how you make the stochastic RSI much more reliable, clean, simple, and effective. Okay, that's it for today's lesson. Stochastic RSI is not magic and it's not complicated. It's simply a faster, more sensitive version of RSI. Today you learned the difference between RSI and stochastic RSI, how to read the two lines, and most importantly, how to avoid fake signals using only two simple. If you just follow this structure, your entries will already look smarter than random crossovers. If you found this lesson helpful, like and subscribe for more practical strategies. Comment below if you want a tutorial on a specific topic. I'll make it for you. Thanks for watching and I'll see you in the next video.